rational thing for the stock to do is actually to grow in line with the earnings. So for example, if the stock price is 100 rupees and if the earnings is growing by 15%, then the stock should also grow by 15%. So it should actually become 115 in the next year. So that's the rational thing for the stock to do. But in reality, that's not what actually happens. In reality, the stock price will actually be growing exponentially. It's out of line with the earnings growth. So if earnings on the grows by 15%, stock may actually grow by 100%. That is due to the irrational exuberance of the crowd and due to the fear of not missing out on the growth story of the stock. So that is what actually makes the price of the stock grow and goes to the stratosphere and becomes a bubble, and when it bursts, all things go down. So what will be the rational thing to do in this scenario is to actually compare the price of the stock with the earnings. There is something called the PE ratio. The inverse of the PE ratio is earnings yield. PE ratio the price to earnings. Earnings yield the earnings by price. So if a PE of the stock is 20, its earnings yield is 5%. That means if you invest in the stock, you will get a 5% earnings in return. So that is what it means. So the matter of 5% returns take 20 years for the stock to double. That is what it means. P is 10, its earnings yield is 10. It will take 10 years for the stock to actually double. There is another ratio called PEG ratio, which is price to earnings divided by growth. If the PEG ratio is less than 1, it's a undervalued stock. The PE ratio is equal to the growth, it's a fairly valued stock. These are some metrics which will actually be giving you an indication as to where the stock is and how overvalued or undervalued it is. Price to book ratio this means how stock is valued with regards to its net worth. The net worth of the stock is 1000 price, and if it's 2000, then PB ratio is actually 2. That means the stock is actually quoting at a price of twice the net worth. Using these type of metrics, you can actually value the stock and determine whether it's undervalued or overvalued. If it is undervalued, then you can actually buy the stock. If it's overvalued, then you can actually ignore the stock. Let us see a couple of stocks here which belongs to the Adani group. See, the first stock is Adani Green Energy and the second stock is Adani Transmission. See, Adani Green Energy, it's quoting at a PE ratio of 700. That means it will take actually 700 years for the stock to double. Clearly, this stock is in a bubble territory. And if you see the PB ratio is greater than 50. So the PEB ratio should be actually in the range of 1 to 2. But here it's more than 50, so it's clearly in a bubble trend. You won't know when the bubble will burst and the stock will come down. So just because the stock has actually grown well during the past, it doesn't mean that it will grow the same way and will in the coming years or something like that. As far as the quality of the stock is concerned, its return on equity figure is reasonable and its return on capital employed figure is also reasonable. But if you see the debt figure, it is very inflated. That is an indicator that the balance sheet is not healthy. If the company is not able to pay the debt, possibility that its ratings will come down, due to which the stock price will also come down. Once the company is looking good based on ROE, ROC and debt parameters, then only you should actually look at the price to earnings ratio and the price to book ratio and the price to sales ratio. So all that glittering stocks are not gold. Stock is glittering. That is, if it is being spoken everywhere, if it's being recommended by top people, then it doesn't mean that the stock is worth buying. You can actually see the balance sheet of the company, see the parameters like ROE, ROC and debt parameters. Buy only when the stock is undervalued.